Welcome to TMS Insights. Jeremy Hook and Ben Clark bring you in early September a review of the August reporting season, which was quite a different one to what a lot of people expected, I think. And overall, we found quite a bit of good news, Ben, in what was expected to be a pretty lousy season overall.
Yeah, I mean, I think we did flag in a couple of videos ago that expectations had really dropped away when we're looking at consensus analyst forecasts. And so probably an easier hurdle for a lot of companies to jump over. But the bizarre thing to me was just how some companies are absolutely battling to get through this COVID environment, others booming. Yeah. And, we see that with the clients we speak to in business.
Definitely,
and It's just created this real thing of winners and losers.
Yeah.
Until we get a vaccine, everyone's trying to make hay or trying to survive.
One thing that's obvious that people need to understand is the economy doesn't equal the share market.
Yep.
And companies have found a way to innovate, get about their work and do well. And not every company, obviously it's been impossible for those in education or travel related stocks, some of the property stocks, but their time will come.
I think so. I mean, it is looking, I think, if with the people we listen to, we have formed a view that a vaccine is looking increasingly likely. Even, sort of with Australians being inoculated by the start of next year. So, and Americans potentially before the end of this year. So there's some light on the horizon. We put up a slide here. We thought this was a good summary which might sort of best show clients the irregularities of this earnings season. And probably the main one has been in the green line you can see there along the bottom. Represents the number of stocks that had a earnings upgrade through this reporting season, and the orange line shows you the number that had a downgrade. And bizarrely,
it crossed over, which is pretty rare, and it doesn't.
Yeah, this data goes back 20 years. There's only been 2 or 3 times in the last 20 years that actually has occurred. So despite all the doom and gloom out there, companies are actually doing pretty well.
And the most recent time that this happened of significance, and the numbers compare really well across dividend and earnings cuts in this period too, was post-GFC.
Yep.
Not in the GFC, the period that emerged out of it. So, and we'll come back to valuation later in the video. We'll get into some reports now, but the valuations will surprise people. They're not that way out at the moment. So, but Ben, talking about the reporting season overall, just to get into some stock-specific stuff, let's go to Ramsay Health in the healthcare. Again, this is a classic case of when not a lot was expected.
Yep, not a lot was expected. Positive earnings surprise in the share price, but a very tough period for this business. Virtually all of its hospitals were closed to any elective surgery procedures. The group had a very tough 6 months.
Yeah.
Of course, we're seeing signs of many hospitals around the world now reopening, and the market, and we're going to sound like a broken record here, the market has looked through the bad news in the past 6 months to an improving outlook for the business.
Woolworths is one where the expectation wasn't as good as what it could have been. So they've had some good times on the sales line, but not on the bottom line.
Yeah, the supermarket business had a bumper 6 months. Of course, we all know that. The hotels business had a horrible 6 months. Yeah. Most of the pubs and hotels that Woolworths owned were closed. The interesting part out of this was that demerger of the Endeavour business is going to happen at the end of this year, it looks like. So it'll be Dan Murphy's and a collection of pubs and clubs and poker machines Woolies own. So that's an interesting one coming up.
That'll be good. On the Vital Harvest and Costa Group, so looking at obviously the fruit sales and obviously the land ownership, there was some good news in amongst this.
Costa had a much better than expected result. They've had a few really tough years, a lot of variables in the agricultural cycle outside of their control, which have hurt them, that seem to be swinging back in their favour now. And, we are quite exposed to Costa through the Vital Harvest, which owns all of the farms that Costa are on. It's interesting, there's been a change of control in the management company who took a very large stake in Vital Harvest at the same time. We spoke to them late last week. Got some good feedback on Vital. I think potentially a more promising future and a better relationship between the two companies is emerging. But the main driver for Vital is an improving coster.
Yep.
And it looks like that's happening.
Yeah, operations are good there. Plumbing stocks, you always liked a bit of plumbing there. So Reece and Reliance, actually. I mean, Reece recapitalised. Gee, it was good to see a great family-owned business kick on, and good economic news coming out of the Reliance story from the US.
Yeah, look, Reece, this was their 100th year's result, and it was an all-time earnings number for them. So a pretty good way to bring it in. Much better than expected numbers out of America. There's a theme here. James Hardie, Reliance, and Reece have all reported strengthening renovation, alteration activity, and building activity, particularly in the south of America, where Reliance and Reece are most exposed. So that seems to be carrying through, and the Australian business has been not growth, but it's held up well. So
CSL, solid result. Invacare, tough times.
For bizarre reasons, really, you got to laugh. Everyone thought Invacare would be a beneficiary of the COVID. And of course, we haven't had a flu season full stop here. Everyone's social distancing, washing their hands, no one's dying. And even with that tough environment for them, funerals were capped at 10 and 20 people for most of the half. So even when people were passing away, they couldn't make any money out of it.
And there were virtual ceremonies that just don't bring the revenue. You can't charge for these things. So it's tough times for them. But CSL really doing very well. They did pull back a bit at the end of reporting, didn't they? So not so much to do with the result or anything, but they have had a very good run over the last couple of years.
They have. I reckon they look pretty good at the moment as a long-term buy. I think they've come back to a reasonable sort of PE, and they've had some issues collecting plasma in America because people have been in lockdown. They can't get out and donate blood. The price has risen that they've had to pay people that are donating blood. But despite that, they reported a strong result.
Ben, this was a dividend strike from a lot of companies, a lot of cuts. I think 70% of companies cut or suspended dividends. Two infrastructure plays that look really good and are paying good income, a Spark Infrastructure and APA Group.
Yeah, and I think if you're looking for yield or something that's giving you a good return, these are the top of the list. APA is probably the one I favour at the moment. It came off about $1 on its result. So at about 10.40, 10.50, you're getting a yield of about 5.5%, 5.6%, including some franking. And they have been able to grow that dividend stream for many, many, many years now. And it's actually been a really good kind of share price growth investment. Spark's been more stable, but it offers a better yield of 6.5% at the current price, which versus less than 1 in TDs now looks really attractive. So there's a couple of ideas there.
And investing for yield's tricky at the moment, not just because of that, because most of the best opportunities exist in relatively low dividend paying stocks.
Yeah.
And we do want people to be investing in those growth kinds of areas, but it's nice to have a couple of good base quality companies to invest in like those two for income.
Absolutely.
Now on that theory of that, the valuation, we've got another chart we just put up here now, which shows how the earnings yield of the market divided by the bond yield actually means that right now people shouldn't be surprised by this fact perhaps, but the market isn't that expensive in historic terms. It's actually quite good value.
Yeah. So if you're just looking at this chart, I think the first thing people might be asking is what's the earnings yield? The earnings yield is the PE reversed. So it's the earnings per share divided by the price per share. And if you then divide that by the bond yield, what it gives you is a reference point for what you should be paying for shares given the current interest rate setting. And this data goes back to 1992. And you can see that this historic level has been 3.
The average level, yeah.
Average level. And
Bang
on that. This was actually about a week ago, so we're probably dipped below that now in the last few days. And
so anything below that is a reasonable buying example. So provided that interest rates stay low,
right,
which
and that's
is what we're expecting.
That's the big sort of disclaimer. If there is a sign of a reversal in bond yields, i.e. they're going to start going higher, then you would certainly see this come off the other way. But I don't think any of us can see interest rates moving higher anytime soon.
That's not likely. And it is fair to say in this environment, equities have had a good move up after the sell down in March. The reporting season gave us good reason to understand that. The outlook from a number of these companies doing better than the broader economy does explain it. And with valuations like you're seeing on that particular graph, don't be surprised if we see market, moving around a little bit, but overall gaining further as the back end of the year comes.
And I think leading into the end of the year, and we discussed this in the last video, I think this vaccine is going to play a big part. There could be a rotation of money in the market. Some of the stocks that have really struggled might have their day, and that might come at the expense of some of the stocks that have done really well. But that will help feed the index, and we might be in for a stronger finish to the year from where we're sitting at the moment.
Great. Well, that's all we've got time for now, and we'll be back later in September with another update.